Stephen Gandel is here with us in Studio 57. He's a U.S. banking correspondent for the Financial Times, and he joins us to talk about what we've been seeing over the last couple of days, last couple of weeks. So let's talk first, Stephen, about what's going on in Europe. European bank markets have somewhat stabilized after Switzerland announced a roughly $50 billion in funding for Credit Suisse, the much maligned, much troubled Credit Suisse. The first question is, Credit Suisse has always been in turmoil. I mean, there hasn't been a time in the last couple of years that they haven't faced some kind of internal turmoil. But what implications does the gyrations happening there have with regards to the U.S. market?
Well, the word out to U.S. banks and just counterparties in general is that if you have some business at Credit Suisse, you need to move some of that. And so it's the interconnectedness of the U.S. banking system, and the banks feeling this, not what we were feeling last week into the beginning of the week, but the U.S. banks that are feeling the Credit Suisse are the ones that are most connected to international markets, which are like Citibank and Morgan Stanley, the most internationally focused. It doesn't mean there's going to be a problem with those banks, but it does mean that over the next few days, people have to move money around, make sure they don't have too much counterparty risk with Credit Suisse or somebody else. And so that's what we're seeing.
And just to be clear, when you say people have to move money around, you're talking about the institutions, not
individuals.
Yeah, not individuals.
This is not.
That's what I want. Just make sure the audience is.
No, it's
so
not.
They understand. Yeah.
It's not an individual problem, but where there's concern is that if some bank has too big a trade on with Credit Suisse, or too big a trade on with someone that also has too big a trade on Credit Suisse, they have to unwind those trades, and there can be some losses there. It's not necessarily. It's something that creates some movement and turmoil, but it's not necessarily anything that can, it's likely to undo a bank.
So let's talk about what's happening here. Despite the fact that there were assurances that the money in Silicon Valley Bank and Signature Bank, it's insured. The banking system is stable. We saw people lined up outside of Silicon Valley Bank ready to take their money out. It just made them uneasy. Where are people putting their money now?
So a lot of the money is moving into, and it's not just Silicon Valley Bank, it's not just Signature, the two banks that were taken.
Because the regional banks in general, people express concerns if you looked at the stock market.
Right. You have a lot of regional banks that have done a lot of business with wealthy clients and businesses, similar to Silicon Valley Bank, and those people are nervous that their bank may be next. And so they're moving it to the banks that are considered the safest. And that includes JP Morgan, includes Bank of America, includes Citigroup. And so those banks have, they've upped their resources, what they say. It said, we don't have, it's not that they're hiring people, but maybe there's some people who used to be doing loans. They've moved them over to this processing, getting your bank accounts open as fast as possible because people are nervous. Yeah. And those are likely the safest banks. The flip side of that, why we might be concerned, is that, remember this problem too big to fail? Well, it's just kind of reinforcing it. More and more money goes into JP Morgan, Bank of America, Citi. They look safe now, but maybe the next crisis is about them.
So, Stephen, this morning on CBS Mornings, we had Senator Marco Rubio on, and I asked him about his support of the Dodd-Frank Reform Act in 2018, which passed with bipartisan support. You had liberals like Barney Frank that supported it and Marco Rubio. And part of the discussion then was they wanted to deregulate the banking industry, at least when it relates to smaller banks, to encourage small business loans. And I asked him if it was a mistake to support that, given what we've seen in the last couple of days. He doesn't think it was a mistake. He pointed to the San Francisco Fed as having realized that there were issues with Silicon Valley Bank about a year ago, but nothing happening. Why did that transpire? And what is the regional Fed's role in this?
So I think the Fed did take their eye off the ball with smaller banks. You're always fighting the last crisis, right? So the rules that were put in place after the financial crisis and Dodd-Frank, what they mostly do is make sure the biggest banks are safe. And so the argument in 2018, when this was happening, and before that, Barney Frank had been pushing this change, as and with a lot of weight because his name was on this bill. So the idea was that the regional banks were not going to cause a problem. And so there was a debate, though, about how high this cap should be. And so it was at 50.
50 billion.
It was at 50 billion. Once you had more than 50 billion in assets, you were part of this regulatory scheme that was for the very large banks. And Barney argued that, I made a mistake. This was too low. He wanted 100 billion. it ended up being because of lobbyists and others, and it went up to $250 billion. So I think probably in there's a mistake that it made sense to raise it to promote small business lending, but clearly they went too far, right? And the banks that are failing now are in that range of $100 billion to $250 billion of assets.
Meaning that there's not what they called back then stress testing. Above $250 billion, they're constantly checking and looking into the books, I guess, and below that, it's a little bit more laissez-faire.
Exactly.
Yeah.
So they took their eye off the ball. They allowed a lot of smaller banks to get into crypto. They allowed this weird transaction where FTX actually bought a bank in Washington State. So they weren't looking at the smaller banks because we thought, okay, there's never going to be, it's always the big banks that cause problems. Well, now it turns it's not the case. It did make sense to raise that cap, probably somewhat. But when you do that, you need more regulation. And I think that part was not followed through.
Stephen Gandel, great talking to you.
Always great talking.
Yeah,
Thank you very much.